Most investors don't realize they're leaving hundreds of thousands or even millions of dollars on the table, and it's not because they're reckless, it's because they picked the wrong dividend ETF. In this video, I'm going to break down the differences between DGRO and SCHD. Which one grows your portfolio faster? I'll break down their performance, compare their strategies, and help you and John decide which ETF might be the better choice for your $100,000 investment. In the end, I'll walk you through a side-by-side projection that shows which ETF could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. But before we get into the numbers, let's clear up what these ETFs actually are. Because yeah, they're both dividend ETFs, but how they go about it couldn't be more different. Starting with DGRO, this is the iShares Core Dividend Growth ETF. It's been around since 2014 and comes from BlackRock, one of the biggest names in investing. It focuses on U.S. companies that not only pay dividends but also have a consistent track record of increasing those dividends year after year. It tracks the Morningstar U.S. Dividend Growth Index, which applies specific filters to screen for financially stable businesses with sustainable payout ratios and solid earnings. DGRO holds over 400 stocks, giving you exposure to a wide swath of the U.S. economy across tech, finance, healthcare, energy, and more. It's designed to capture steady long-term growth from businesses that don't just return cash, they grow it. On to SCHD, or the Schwab U.S. Dividend Equity ETF. This ETF was introduced a few years earlier in 2011 and is managed by Charles Schwab Investment Management. Unlike DGRO, it targets companies offering higher dividend yields right now with good dividend growth, but it's very selective. SCHD tracks the Dow Jones U.S. Dividend 100 Index and screens for companies with strong financials using strict metrics like return on equity, dividend consistency, and cash flow. With just over 100 stocks, SCHD is more concentrated. But that also means it zeroes in on high-conviction, cash-rich companies that tend to be more mature and income-focused. So DGRO is broadly diversified and growth-oriented, while SCHD is more selective, yield-driven, and focused on financial quality. Both are strong, but they're built slightly differently. Now, let's see what those differences have meant when it comes to actual returns. Over the past 10 years, DGRO has returned 136.32%, showing steady and consistent price appreciation. In the last 5 years, it delivered 70.27%, and even over the past year, it was up 10.42%. That consistency makes it appealing for investors who value growth that doesn't come from wild swings. DGRO has handled both bull and bear markets with relative stability, offering a dependable track record for compounding returns. Now, it's not a monster dividend payer right out of the gate. Its current yield sits at around 2.2%. While not the highest, its advantage lies in the growth of those dividends. Over the last decade, its payouts have grown at a solid pace, giving long-term investors more income each year without needing to chase yield. It currently pays out about $1.39 per share annually, and that number tends to increase steadily. This makes DGRO a strong choice for those focused on building future income rather than collecting maximum dividends right now. Its expense ratio is a lean 0.08%, and the fund manages around $31.48 billion in assets. That combination of cost efficiency and scale adds to its reliability. The strategy behind DGRO, investing in companies that consistently raise their dividends, has clearly worked over time in terms of both price growth and dividend strength. Now shifting to SCHD, the numbers paint a different picture. Over the same 10-year period, SCHD delivered a total return of 103.64%. Over the last 5 years, it grew by 55.92%, and in the past year, it's up 3.97%. While these gains are still strong, they've trailed DGRO across each time frame. However, SCHD isn't trying to beat the market on growth alone. It's built for something else: income. Its dividend yield is 3.86%, a lot higher than DGRO's, and that makes a difference if you're someone who likes seeing real cash hit your account every quarter. It pays around $1.04 per share right now, and while its dividend growth is also very good, it lags slightly behind DGRO's. The fund is also extremely cost-effective, with a rock-bottom expense ratio of only 0.06%. It's large, too, managing over $69.93 billion in assets. That level of adoption points to strong investor confidence in SCHD's income strategy. And when you compare both to the S&P 500's 12.04% one-year return, you can clearly see the performance gap. DGRO came in at 10.42%, holding up fairly close and showing strong participation in the broader market rally. SCHD, on the other hand, delivered 3.97%, which is a much slower climb by comparison. That difference highlights how DGRO leans more into growth while SCHD is structured for income. While both are quality ETFs, they behave differently depending on what the market rewards in any given year. In the end, I'll walk you through a side-by-side projection that shows which of these ETFs could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. All right, so we've seen how these two ETFs have performed over time, but to really understand why they've performed the way they have, we need to look into the holdings. Because what each one actually owns tells you a lot about how it works and what kind of ride you're signing up for. Starting with DGRO. This one spreads its money out across 415 different companies. That's a lot of ground covered, and it means you're not relying too heavily on any single business to carry the weight. In terms of sectors, DGRO leans pretty heavily into financials at around 22%. Then tech takes up nearly 20%, and healthcare grabs about 15%. After that, you've got consumer staples, industrials, and utilities all showing up in decent amounts. There's also a sprinkle of exposure to energy, real estate, and a few other spots, but none of those smaller sectors make up more than 6% each. So there's nothing too lopsided here. And when you zoom in on the top holdings, the names all sound familiar. Microsoft leads the pack, followed by JP Morgan, Broadcom, Exxon, Johnson & Johnson, Apple, and a few others like Procter & Gamble and Home Depot. These are big, stable companies that don't just pay dividends, they've got a habit of raising them year after year. And even the top 10 stocks only make up about 26% of the whole fund, which keeps things well balanced. That's a big reason why DGRO tends to feel smooth and steady. Now, SCHD, it plays a tighter game. Instead of spreading its money across 400 companies like DGRO, SCHD sticks with just 103. That's a much more concentrated lineup, and it's very intentional. This fund doesn't try to own a little bit of everything. It's all about picking a smaller group of what it sees as the best, most reliable income machines out there. When you look at the sectors, SCHD leans heavily into consumer defensive stocks. That's stuff people keep buying no matter what, like food, drinks, or household goods. Right behind that is energy, and then healthcare. So already you're seeing a focus on essential industries with strong cash flows. It's also got decent slices of tech, industrials, and financials, and just a bit sprinkled across areas like communication and materials. But what stands out the most is how much weight it gives its top holdings. The biggest names? You've got Cisco, Coca-Cola, Verizon, Texas Instruments, Lockheed Martin, Altria, ConocoPhillips, Home Depot, Chevron, and Amgen. And here's the thing, those 10 companies make up over 41% of the whole fund. So when any one of them makes a big move up or down, SCHD feels it more. That can be a good thing when these stocks are doing well, but it also means SCHD is a bit more sensitive to individual company performance. In simple terms, DGRO spreads its bets widely with a growth-oriented tilt, while SCHD builds a high-conviction portfolio focused on quality dividend payers with strong fundamentals. And speaking of how much these ETFs pay you, let's talk about what really matters to a lot of investors: dividends, taxes, and that steady cash flow. For many investors, especially those looking at ETFs like DGRO and SCHD, the question isn't just how much will it grow, but how much will it pay me and what will I owe on that? Both DGRO and SCHD pay dividends quarterly, so you're receiving income 4 times a year. That's a big plus for people looking to build passive cash flow or reinvest their dividends over time. The big difference comes down to the size of those payouts. SCHD's current yield is 3.86%, while DGRO's sits at 2.19%. That means for every $10,000 invested, SCHD would pay out roughly $386 per year in dividends, while DGRO would generate closer to $219. If you're counting on those dividends as income either now or down the line, that gap matters. But dividends also come with taxes. For most U.S. investors, both DGRO and SCHD primarily pay out qualified dividends, which are taxed at the long-term capital gains rate, not ordinary income tax rates. That's good news. Still, if you're holding these in a taxable account, you'll need to report those dividends every year, even if you reinvest them. That's why many people choose to hold dividend ETFs inside tax-advantaged accounts like a Roth IRA or traditional IRA. In a Roth, your dividends grow tax-free. In a traditional IRA, you defer taxes until withdrawal. Both options help you get the most out of your reinvested dividends without losing a chunk to the IRS each year. In a couple of minutes, I'll walk you through a side-by-side projection that shows which of these ETFs could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. But first, a piece of the puzzle that a lot of people skip over. How does it feel to own these things? Because numbers are great, but if your portfolio is making you lose sleep at night, that's a problem. Let's talk risk, volatility, and peace of mind. Now, both DGRO and SCHD are designed to be more stable than the overall market. That's part of the appeal. But they each go about it in slightly different ways, and the result? A different kind of ride for the investor. Starting with DGRO. It's kind of like that friend who never panics. Its standard deviation, which is just a fancy way of measuring how much the price moves around, is about 11.7. That's on the low side, meaning it tends to glide instead of jump. Its annual volatility? Around 15.1%. Again, that's pretty chill compared to the average ETF. So if you're someone who likes consistency, this is a fund that doesn't get too rattled when things get noisy in the market. DGRO also has a low turnover rate, only 25%. That means it's not constantly switching out stocks, which helps keep things more predictable, especially if you're holding it in a taxable account. Fewer trades mean fewer unexpected tax bills, and that's a win in anyone's book. And then there's tracking error, which tells you how closely the fund sticks to its intended index. Over 1 year, DGRO's tracking error is about 7.7%, and over 5 years, it drops to around 6.2%. Not perfect, but pretty solid. That consistency helps explain why DGRO feels like a smoother, more stable ride, not flashy, but dependable. SCHD, on the other hand, comes with a little more personality. It's not a roller coaster, but it definitely has more ups and downs compared to DGRO. SCHD's standard deviation, remember that's how much it tends to bounce around, is about 14.6, which is noticeably higher than DGRO's. Same goes for annual volatility, which clocks in at 16.3%. Still not extreme by market standards, but it does mean you'll probably notice the bumps a bit more, especially when the market gets shaky or interest rates start doing their thing. Its turnover rate is a bit higher too, sitting at 29%. Still relatively low, but it suggests SCHD does a bit more shuffling in the holdings. And more movement can sometimes mean more surprises when it comes to taxes or performance. Now, here's where things really stand out. SCHD's tracking error. Over the past year, it's been about 13.2%, and over 5 years, just under 10%. That tells us SCHD doesn't always stick super closely to its benchmark. It's not necessarily a bad thing, especially if the fund manager's strategy is working, but it does mean the result can sometimes drift a bit from what the index is doing. And remember how SCHD puts a big chunk of its money, over 40%, into just 10 companies? That kind of concentration can be powerful when those top names are doing great, but if one or two of them stumble, it can weigh down the entire fund. It's a double-edged sword, more focused potential, but also more exposure to single stock swings. From a technical standpoint, both funds score well. DGRO currently carries a strong buy rating, while SCHD is rated buy, showing strong momentum in both, but with more enthusiasm leaning toward DGRO. But of course, performance, cash flows, tax-smart strategies, and technical analysis are only part of the puzzle. If you're thinking long-term, like really long-term, the next question becomes, what happens to that $100,000 investment over 30 years? Let's run the numbers. Starting with DGRO, I'm working off some reasonable numbers collected based on the past 10 years' data, that your investment grows at about 9.08% a year in share price, with a 2.2% dividend yield, and that those dividends keep growing at roughly 12.5% per year. Based on these metrics, after 1 year, your $100,000 investment will be valued at $111,280. After 10 years, you'd be looking at $301,140. That alone would be impressive, tripling your money in a decade with no added contributions. But things really take off after that. By year 20, your portfolio would hit just under $1 million, $994,909. And by year 30, it explodes to $3.74 million, paying you nearly $16,000 per month in dividends. That's $191,300 a year just in income. A big chunk of that comes from those dividends being reinvested and compounding along the way. When you break it down, about $2.38 million of your total comes from capital appreciation, and another $1.25 million comes from reinvested dividends. So here's the big question, can SCHD beat that? Well, let's run the numbers. Same starting line, $100,000, but the numbers are just a little different. SCHD grows a bit slower on the price side, about 7.45% annually, but its dividend yield is higher at 3.87%, which grows at about 11.3% a year. No extra contributions, just time doing its thing. After the first year, your SCHD portfolio will grow to $111,320. Fast forward 10 years and you'll be at $312,338. 20 years in, your portfolio would climb to $1.17 million. And by year 30, you'd be looking at $5.78 million. That's nearly $2 million more than what DGRO delivered under the same time horizon. But it's not just the total value that grabs your attention, it's the income. By year 30, SCHD is projected to pay over $46,000 per month in dividends. That's $562,560 every year. So where's all that value coming from? About $2.5 million is capital growth, the rising share price over time. But a massive $3.17 million comes from reinvested dividends. That high yield, when paired with time and compounding, turns into an absolute powerhouse of income. So which one is better, DGRO or SCHD? Between DGRO and SCHD, both are solid ETFs, but if we're calling a winner, especially from a long-term investor's point of view, SCHD takes the crown. Here's why. Over 30 years, SCHD turns $100,000 into roughly $5.78 million. DGRO, around $3.74 million. That's a $2 million difference. Even more important, SCHD's projected annual dividend income hits $562,000, or about $46,800 a month. DGRO, around $191,000 annually, or $15,900 a month. That's more than double the cash flow. Now sure, DGRO has smoother price swings and a slightly more diversified approach, but when you zoom out, when you really look at long-term value creation, SCHD's higher yield and compounding power just hit harder. So you're getting more income, more reinvestment, and more total return. So, unless your number one goal is avoiding a few percentage points of volatility, SCHD is the ETF that builds wealth faster and pays you bigger over time. It's simple. More income, more total growth, more financial freedom. That's why SCHD wins. Want to know how to turn $100,000 into a $10 million portfolio? Click the video on the screen to find out.